Hey, it's Mike. I'm not an investing guru. I'm an average guy sharing my investment journey on the internet. In today's video, we're going to talk about me building a side stream of income using other people's money, and I'm still doing it. We're going to talk about the portfolio. We're going to talk a little bit about the Trump tariffs, as well as some of the YouTube comments from my last videos. All right, let's get started. First things first is let's talk about my portfolio. So this is my Robinhood portfolio. I don't really say this that much, but I have 3 different stock accounts. I have my 401k, which predominantly invests in the S&P 500 and the Total International Fund. No bonds in that one. And then my Roth IRA, I have SCHD and SCHY, which is both the international as well as the US dividend fund. And then this account, this brokerage account, is where I can get creative in how I go about trying to accrue the highest gain possible. So for me, one of there's 2 ways to rapidly grow wealth. One is to start your own business. So if you want to own your own manufacturing company, you want to mow people's lawns, that is the fastest way to make a lot of money really fast. The other way is to invest, or you could own real estate, but the other fast way is to own really good companies that are growing their revenue as time goes on. So in this portfolio, that is what the ultimate goal is I'm trying to use creative strategies to optimize my income. So the goal here is always to outperform the S&P 500. Have I done that every single year? No. Have I beat it certain years? Yes. So in this account, I have $227,000, and predominantly I own Tesla. And just a quick one-liner on why I own Tesla. There's a couple factors. Again, you may agree or disagree with these, but these are what I view as the next things going forward. So I believe that Tesla, the reason most people invest in Tesla is for their robotaxis. Now, am I a huge electric car advocate? Not necessarily. However, electric cars are more efficient, have less moving parts, which ultimately less things for people to fix. So why am I investing in Tesla? So ultimately, one of the main things is AI. Tesla is one of the biggest AI plays that a lot of people don't necessarily talk about. A lot of people, they know what ChatGPT is, XAI, OpenAI, all those different things, but Tesla is one of the biggest real world AI players. And ultimately what their plan is, a lot of these OpenAI and ChatGPT, what they do is they have large language models, and those large language models predominantly operate in the internet or in that sphere. However, that necessarily doesn't interact with humans on the day-to-day. Whereas what Tesla's trying to do is trying to take this real world AI and have it live with humans. So that's essentially what the robotaxis are, or the full self-driving. So what they want to do is they're putting this artificial intelligence where you keep training all these massive computers to learn how to drive. And ultimately what it's doing is the car is a robot and it's interacting with how other humans are driving, how they're responding, and they respond to those interactions. So that is one of the main reasons why I'm investing Tesla. The other reasons is they have a huge energy business that is so untapped. And if you look at the earnings reports, they're growing like 50 to 100% year over year. And that is a huge untapped market where, as a lot of times when we generate electricity here at least I live in America, so I don't know how it is in other countries, but in America, you have your main plants, and then what you'll have is you'll have peaker plants. So when there's a lot of demand for electricity, they have to do this very expensive process to turn this huge plant on just to get to the electricity that we need. However, where Tesla has a competitive advantage is they sell these really big batteries that instead of having to build a peaker plant or turn that on, what they do is when on off hours, they can generate enough electricity stored in the batteries. And instead of having to turn an entire system on, you could just pull from the batteries. And it's this feedback loop where, it fills the batteries, uses it on peak demand, fills the batteries again when it's less demand, and that is substantially cheaper than running those large peaker plants. So that's a business side that a lot of people don't really talk about, but that is another reason why I'm investing heavily in Tesla. Ultimately, then once they use that artificial intelligence, then they will push that into the humanoid robot, which will innately do your lawn care, clean the house, get groceries, things like that. But that is kind of like the reason why I'm investing in Tesla. There's really not a lot of companies that are going to offer that much value going forward. So that's kind of like my one-liner reasoning. So it's the full self-driving, robotaxis, Optimus projects, energy storage, and those are the main things for that. Okay, so that's why I own Tesla. And then now, I own 900 shares. And what is my plan? So normally in the past, when I made these videos, I showed me borrow money against my positions, and then I would invest in these covered call funds. Predominantly last covered call fund I invested in was XDTE. And when investing in XDTE, I've noticed a couple things. So the reason why I don't currently invest in the XDTE is a couple factors. No matter what, you will never outperform just the general market. If you're willing to accept that fate, you're taking the right steps. The next thing you're going to have to understand is that every single time you get a distribution paid, it just pulls from the share price. So for example, if you get a 20-cent distribution, it's at $50. Now your share price now is $49.80. So technically, when that distribution is paid, your share price goes down. This happens with every other stock as well. So any dividend paying company or whatever, they do this exact thing. And with these funds, I noticed that it happens way more than, say, doing it yourself. The third reason is tax efficiency. So I was under the assumption that these are supposed to be slightly more tax efficient than running option investing yourself, and that ultimately once you get to your cost basis, then you will have to pay taxes. However, I follow my taxes, and I seem to have had to pay a lot of money in taxes investing in these yield max and round hill funds. So those are the couple of reasons why I don't invest in these like covered call strategies. What I came to the conclusion is actually one of the best ways to make the money is just to do it yourself. You're not paying an expense ratio. You know exactly what the taxes are going to be. You're not going to be getting caught off guard in any of those regards. So what my mental plan is, I still want to invest in Tesla, but I want to optimize my income from doing that. So I have two strategies that I'm doing. So the first strategy is I want to sell a cash secured put wheel. And what that wheel looks like is my goal is I want to make 10% a year selling cash secured puts. So I want to have a delta of about maybe 10, 5, maybe even lower, depending what the premiums are. And then we can sell cash secured puts on individual stocks or ETFs. Okay, what I'm doing is the part where I'm using other people's money is I'm going to be using option collateral. So whatever my equity is, 50% of that I'm going to sell in cash secured puts. So for example, today my portfolio was worth $228,000, and this is the position that I opened today. So $224,000, half of that came out at $113,000. So if you do $113,000 by this 165 put, you can buy about 6 contracts worth. And in doing so, I want to get a 10% gain on that. So whatever 10% of $113,000 is, comes out to, was it like 10,000 bucks or whatever? So it comes out to like, it came out to like 30 cents per contract, per 6 contracts. Or it was like 25. And so ultimately I bought this position, or I got about 38 cents per credit, which came out to about 200 and what is the full payment here? $228. So every single week, if I get 228 bucks, 10% return on that $100,000 is pretty good chunk of change. Extra $10,000 a year for selling a cash secured put. And let's actually go to the option chain for Tesla. So we're going to trade options, and we're doing about weekly options for the next couple days. So we're selling a put. And so if you look, so the current share price is $250. I chose the one all the way down here, 165. Let's look at this. So now it's about $24 per contract that you would get, but look at the delta. I almost have a 98% chance that this is not going to get assigned to me. And if it does get assigned, I mean, we're looking at like, what is that? 35, like an $85 drop. If the share price of Tesla drops $85, I am more than happy to purchase this. And then if I did get assigned, what I would do, because I would have gotten it at such a good price, I would sell a covered call. And that point, by the time I have to sell the covered call, like we'll maybe hit a little bit of a rebound, you can sell either one of these. Like my thing would be not to do the directly at the money, but I would sell this covered call over here. So say, you'd get whatever the difference between the share price and the share price you purchased and the share price you'd be selling it, plus the option. So like if I was selling 6 calls and if I got assigned, that'd be $6,000 in a week, because I would sell the next one. So the amount of money that you can make is actually a decent amount. I truly don't want to have any of my options assigned. I really don't want them to be assigned, but if they do get assigned, I'm more than happy to sell those covered calls because I would be buying the stock at such a good price. So I'd be using a 50% equity as collateral, and then if assigned, sell at the money covered call or one up from at the money. So just like we talked about, I'd be selling one more above that. And then the nice thing about running cash secured puts versus like owning the underlying and actually selling covered calls is the cash secured puts do not accrue margin interest. So let's go over here. Let's go to my investing tab. So I still have this $43,000 cash position, and we'll talk about that in just a moment. And as you can see here, margin used, $0. I have $0 of margin used. However, I do have options collateral. I have $141,000 of options collateral. So $41,000 of whatever my cash position is. So really is about $100,000 worth of options collateral. But I'm not getting charged interest for this. So if you go to the thing that says like the daily interest charge, I'm getting charged nothing. Daily interest, $0, because margin collateral on cash secured puts do not accrue interest. So the fact that I'm saving money off of the interest, so that doesn't take away from your gain, I'm getting like calculated about a 10% return a year. And it's, you know, a 10% return is actually super conservative. Some people make 2-3% a month, but my end goal is to get whatever I'm trying to buy at such a good price, and that when I do get assigned, I can sell it right away, and that it wouldn't be that much of a hassle. So like if you look at the monthly yield, it's about a 0.83%. So anywhere between $5,000 and $10,000 worth of income. So that is awesome. And then you can sell, you know, daily to weekly options, zero NAV erosion. So every single time that I get paid out my premium, it does not erode my net asset value. It's not like I got this $228 in premium from this one and it took away from my actual account. Like it was just cash that was put in my account. Whereas if you invest in XCTE and Roundhill and YieldMax and whatever, when you get that distribution, it gets taken away from your net asset value or that share price. So I'm not eroding my capital. And like, I didn't realize this. Like I was like making myself try to like be okay with my net asset value eroding with those like, you know, XCTE funds and Roundhill funds. But then deep down inside, I'm like, that doesn't make any, like, why am I going to let my principal erode? Like, I know like stocks trade up and down, but like, you know that your principal is eroding with every single dividend payment. And then like you have to reinvest back in to maintain it like that kind of hurt. Like that to me didn't make any sense. So that's kind of where we're at. And then, you know, we're still building a side stream of income without using my own money. That is other people's money that is being set aside as collateral. This collateral that is being set aside, this is other people's money. This is not my money. And if I can use other people's money to get a 10% return on the amount that I used, that is amazing. So like if I had just like, for example, say I did not own any Tesla and this was the S&P 500, you can still do the exact same strategy with the S&P 500. So not only would you own the S&P 500, which would be that long-term growth, you can actually make that extra income. So innately, you will always outperform if you do like that. And then if you do get assigned the S&P 500 at the deltas that I'm saying it is, or you sell your dailies, like you'd be getting at such a good price. So then if you wanted the income, you could just sell it right away. Like this to me sounds like a no-brainer. And I think like, you know, this is kind of the strategy that I'll be moving forward. Okay. The second strategy that I'm implementing, and I've been somewhat doing this, but I got burned because, again, I got a little bit too greedy. And that's what happens when you invest in the stock market. You get greedy, you can feel it overcome you. And this is my long-term covered call strategy. So when I was doing my due diligence and back testing all the XDTEs and running covered call option strategies and things like that, the first thing that I noticed is that the type of option investing that nets the most return is actually selling covered calls. However, to some point, you will always get assigned. Now, I asked the ChatGPT in the backtesting programs, what is one of the optimal ways to increase your gain without having that much risk? So it's actually selling far out of the money covered calls on the holdings you own. So if you own the S&P 500 or Tesla, if you sell above like a 15, 10, 5 delta, you can get a little bit more in premium on top of like capturing all the upside in the appreciation. So if you own the S&P 500 and you set like a 10 delta on a daily or a weekly or monthly or whatever your time horizon is, if you do that, you will not only outperform the market, you're going to get that extra gain. So the only thing about here is in this position is I was selling covered calls on Tesla, but then somewhere around this point, I was selling a really like a 30 delta and I got assigned and I had to roll it and then I had to roll it again. So my overall option income here is about $15,000 because no matter what, I always want to roll for a credit. So I rolled it all the way out to credit. However, one of the things is the expiration is January 27th, or January of 2027. So I do have it like for further out of the money, but at some point when I get closer and it gets, if it blows past the strike price again, or I could buy back the options, I probably will. But right now I'm just kind of sitting pretty. So there's nothing I can do on this, but the plan would be this, like once this is like expired, then I can go ahead and run those like 15, 10, 5 deltas. But just looking over the goals. So again, this one, we're not using margin. And the plan here is to make 5% of income on your money. So in the cash secured puts, the goal is 10% on the borrowed money. This one is only 5% because I'd rather capture the upside versus the premium. So even if I get, if you own the S&P 500 and you can gain 5% extra a year, and then the market's been returning 10% a year, you'd be making 15% a year. So you'd be really blowing past, like you'd be really outperforming in that strategy. And here, I'm not trying to do the wheel strategy. And the reason I'm not doing the wheel strategy because, long-term investing, I want to invest in great holdings and I want to just optimize a little bit more income. So I'm not going to be waiting for it to get assigned and then like selling a cash secured put. No, like the plan here is to absolutely positively avoid assignment. If I cannot, then I cannot, but like I'm going to do everything at all costs to avoid assignment. We're capturing as much growth also while acquiring premium. The goal again is always to outperform the S&P 500. We're avoiding assignment. The goal is growth first, income second, and then no margin. So I'm not borrowing money to do this strategy. Whereas in the other one, this is the side stream of income. But you can see here. So last week I made about $165 doing this strategy, and then this week, today's Monday, I put in these two options. But for this strategy alone is $228, and this right here I'm going to talk about here in just a moment. So this $482. So there you'll notice that I'm selling another put option. So with this, let's look here. So with this cash I have sitting on the sidelines, it's $43,000. Guess what? I want to buy more Tesla, but I want to buy it at a better price. So what I'm doing is I am selling this weekly option. So let's just go back to Tesla. We're going back to Tesla, and I want to be selling this weekly option. And what I want to sell this 210. If I do any more, I can't afford it. If I do any less, the premium won't be as high. But so $210 would come out to about $42,000 worth of stock I can buy. So I actually am willing to buy Tesla at this price. So like I'm actually looking to get assigned over here. However, I don't necessarily want it to get assigned. If you look at the premium, when I put the option in, it was about like a 12 delta, excuse me, the delta, not the premium. The delta was about a 12. And so I'd be willing to buy this at about $210 a share. But the stock decided to go up. So then therefore it's a lot cheaper to sell it right now. Well, it'd be 280, about the same. So I'd be willing to buy Tesla. The current price right now is $251 a share, but I'm looking to buy closer to this area. So if this doesn't get assigned, I'm just going to keep, aiming for like a maybe 10, 15 delta until I do get assigned. So then not only am I going to be making, my cash secured put strategy, which is this one, I'll be making money on this until it gets assigned. And then eventually I'm just going to switch to this covered call strategy. And again, just focusing on that long-term growth. So that's kind of where my head is at with these couple of strategies here. So, this one is for that, side stream of income, 10% gain, using other people's money, not accruing interest, no NAV erosion. This I'm actually trying to get aside, but I want to get it at a good price, and I want someone to pay me to buy it at the price I want to buy it. And then this is just that long-term call that, what was that in December that I had to set up. So that's kind of where we're at right now for like the overall portfolio. So, we're sitting pretty good. A couple things to keep in mind is the Trump tariff. So the Trump tariff is coming up. Today is the 31st. Tomorrow is April 1st, and Liberation Day is the 2nd. We're going to be apparently making so much money off these tariffs that we're not going to know what to do with it. So how am I positioning my portfolio? The way I'm positioning my portfolio is there's always going to be some external factors that, can drive the price up or down. But there's nothing necessarily you can do to position yourself. The only thing you can truly do to put yourself in a position to succeed is invest in really good companies. That's what I feel like I'm doing. Again, other people will disagree with the Tesla position, but just you want to put yourself in a position to succeed, and that's what I'm doing. Like I'm buying shares of a company that I know will do well in the future. I'm gonna milk a little bit more premium from it. I'm gonna enhance my gains. I'm gonna try outperform the S&P 500, but that's just kind of where we're at. So I'm not necessarily looking at what these Trump tariffs are gonna do. Like, is it gonna affect Tesla as much? Not necessarily. It's actually gonna affect like GM and Ford way more than Tesla, because Tesla actually it's like one of the most American cars made. Like 83% of the products are made in America, whereas in like GM and Ford, it's like 55%. So, Tesla is actually positioned in a really good fashion for these tariffs. Now, I don't know how those tariffs would affect, Tesla producing, cars in China and then selling it to China. Like, I don't necessarily will, speak on that. But for the most part, like here in the US, like I don't think that's like a really, really big deal. Kind of moving along, the tariffs were one thing. Let's talk about my last video's comment. So in my last video, I admit I was wrong selling out of XDTE, massive Tesla put win. So I did sell that massive Tesla put. It was like an $82,000 margin position. I made money and happy as a clam over here. However, I was already thinking about, what if I took this $42,000 and did another put option position? So let's look at Tesla again. Let's look at the chart. Let's do some technical wizardry here. So this is where we're at right now. We are at $253 a share. We're this middle line here. So the average here has been about 260, 251, 253. So technically, if there's any drop from this point on, we could look to go to 215, 211, maybe even $147 a share. And I was looking, if I put that $42,000 and I went down to $150 a share, I would make an $80,000 option play. However, I started noticing that like I was starting to get greedy, and then I was thinking like, well, instead of using cash, like what if I also use margin to buy a put option? And I started really spiraling and going down the rabbit hole, and I realized like let's not do that. Let's just play things a lot safer. So no puts for me here. And then, yeah, we sold out of XDTE. Let's just read some of these comments here. SPY, baby, jokes aside, I do believe that in that fund. I will watch the video after Walmart trip. Great. Whiskey Danger, my plans to ride out position XDT, QDTE. Every time we hit a correction, I refinance what's left of a personal loan and dump it in. My main portfolio just keeps grinding, no selling, just buying whatever amount I need to keep my investment at the desired allocation. 100% TSBY plus 40% buck margin plus cash. Okay, so again, if you were investing as in long term, like again, I ran calculators and it said they would end up being positive. So there's no harm of doing it exactly like that. But I just, for my portfolio and my sake, I want to do a little bit safer. Finally clicked Vinny. It did. Hope my previous message helped. There are so many people that don't understand it. Possibility. I do read all the comments. So sometimes whatever you say, it can adjust my investment. We're human, and with new information, you can make new decisions. I like the funds, but I'm not bag holding. I sold out of a few positions right before the correction. Great. I don't know if you guys know, when I bought XCT, I bought it at the absolute high. So, I'm glad that, this person right here was able to get out. Boom, you get it. More M224.7, more control, more upside, and no nav erosion. Yep. I've been looking at Google myself, and then NVIDIA. AI takes a ton of processing power. Also, they are positioning themselves in the robot space for manufacturing. They sure are. Giancarlo Ferraria. Technically, the S&P 500 did not go down about 10% from the recent all-time high. NASDAQ down about 15% from all-time. So yes, it is a correction. The million-dollar question is do we get back to all-time highs, or do we keep going down? That's a great question. That's always the question of the day. I personally think there's some more pain in the market. We're still quite overvalued. Like the Shiller PE ratio, which is long-term valuations, we are still at all-time highs. The average is about 16. So huge bump, unless the new norm is this high right here, which again, I just don't know. Like when money's cheap, then it could be that high. But you know, if we have to increase interest rates, not going to be looking good. The hoop scoop. You aren't wrong. It is simply the way the ETF is structured. I found my trading cost to carry was more expensive trading via Tasty Trade versus the annual expense ratio, which is 90% less than what I paid managing a similar trade to what YieldMax Roundhill operate. That isn't counting the stress involved in robotically managing the positions daily. Again, I agree with that. One of the nice things about investing in these covered call funds is you don't have to physically put the trades in. The only thing I would disagree with that statement is that your trading costs do carry over because that expense ratio is incorporating those trading costs. So it is a much higher expense ratio. Unit traders. And then, oh yeah, so Giancarlo commented, like I was shorting Tesla. I got out of that position and then Tesla just ran up again. And I actually closed that position because again, I was not being greedy. I got my $40,000 and moved on. And then, so like, that was a cool comment. Invest in the biggest 3 crypto by market cap, 228 in 5 years. It'll probably be at least 5 times. Mark this comment. It won't. I agree with Schumacher. Crypto is just not, it's fake. It's still fake. It's like investing in gold. It's like you're just investing in a currency. Like there's no actual utility for it. And yeah, that's about it. So, you know, overall, we're positioning ourselves well in this market. You know, we're investing in good companies. You know, we're building that side stream of income using other people's money. We're capitalizing on, you know, our growth holdings appreciating by using covered call strategy. And that's kind of where we're at right now. So, you know, hopefully you enjoyed the video. If you have any questions, definitely shoot them down and I will try answering them. And I'll see you guys. Peace.